Online. Are we there?
Yes, sir.
So we are there.
November 2024, question 3. I'm reading. Are we all there, guys? Search Feli PLC. There's a way you can search now, even with iPhone now. All right, I'm reading. Feli PLC operates a low-cost road transport business. Take note. Operate what? A low-cost road transport business. And is a listed company. By comparison to its major competitors, it is relatively small, but it has expanded significantly in recent years. The shares are held mainly by large financial institutions. The following are extracts from Feli PLC budgeted statement of financial position as I went. 31st May 2023. We have ordinary shares, we have reserve, and then we have 9% bond 2026. What statement is this? 2023 May, Abi? Help me. This bond has how many years to redemption? Everyone. 3 years. Fantastic. 3 years. Dividends have grown in the past what? In the past at how much? 3% a year, resulting in an expected dividend of how much? ₦1 per share to be declared. When? On 31st May 2023. This dividend is my D0. Okay? Is it not? Because I'm working with this current period now. Now, assume for simplicity that the dividend will also be paid on this date, right? You know, in dividend, in SFA, we always assume that when dividend is declared, they must always pay on this date. And so it doesn't affect the price in the market and the rest. All right. So we are assuming here that the dividend, of course, is going to be paid on this date. Due to expansion, dividends are expected to grow at how much? 4% a year from 1st of June 2023 for the foreseeable future. I have 2 growth rates now. What should I do? Should I average? Should I pick 3% or should I pick 4%? And why? Oh yeah, for a bottle of Coke, I have two growths, 3%, and then I have 4%. Should I average? Should I use 3% or should I use 4%? And why?
One is current growth rate, and the other is the future growth rate.
Okay. So basically, very correct. 3% is already inside this one. Abi? Because they said resulting in an expected what? Dividend of how much? ₦1. So it means that this growth actually contributed to why this dividend is currently ₦1. So, and when you are calculating your cost of equity, it's always forward-looking. I'm looking at how much dividend now, plus what is the expected growth on the dividend from today. So it means this 3% is not relevant to me as far as I'm concerned, right? The price per share is currently how much? 10.40 XD, and this is not expected to do what? To change before 31st May 2023. The existing bonds are due to be redeemed at par. When? 31st May. We already ascertained that it's 3 years, Abi, to redemption. The market value of this bond as at 1st of June 2023 is expected to be how much? 100.84 X interest per 100 naira nominal. Interest is payable annually in arrears on 31st May and is allowable for what? For tax purpose. The tax rate for the foreseeable future is how much? 30%. Assume taxation is payable at the end of the year in which the taxable profits arise. The company has now decided to purchase 3 additional what? Vehicles at a cost of how much? 10 million naira what? Each. That means a total of how much are they looking at? 30 million. Don't forget, it's not just 10 million. The board has decided that the new vehicle will be financed in full by what? 8% loan on 1st of June 2023. You're required to A, calculate the expected weighted average cost of what? Of capital of Feli PLC at 31st May 2023. Don't forget, 31st May 2023 is when this place. Abi, and at this point, have they taken the additional loan? No. So it means my sources will just be ordinary shares and what? 9% bond. Are we good? So let's quickly dive in. Illustration 2, November 2024, question 3. Calculation of what? Weighted average cost of capital. Remember, my sources here is going to be equity. Abi, first, equity shares. What else? 9% what? Is it redeemable or redeemable? Redeemable. Redeemable bond. So let's start with equity. We need two things from equity. What are they? Cost of equity and what? Market value of equity. So our cost of equity, which approach are we using? Are we using dividend? That's dividend growth, Abi?
Yes.
Using dividend valuation model, right? That has growth, Abi. And according to that, KE equals to D0 into 1 plus growth divided by MPS X div, then plus what? Growth. No thinking. What's our D0? Dividend in time what? Times 0, Abi. I'm looking at now. And how much is that? 1 error. Okay. What's our growth? Expected future growth, which is what? 4%. And then our MPS X div, Egone, 10.4 naira. Is that not? So can we get our KE, guys? KE equals 1 naira into 1 plus 4% divided by 10.4 plus what? 4%. If you have a good calculator, help me. What's my KE? 14? Eh? All good, everyone? %, that's correct. What do we need next? Market value. Value of equity. How do we get that? Market price per share multiplied by what? Number of shares. Fantastic. So what's our MPS? We already know it to be how much? 10.4 multiplied by how many shares do we have in this company? 100 million shares. Fantastic. Giving me now. 1040. So all market values in Naira million. All right. So we are done with equity. What do we have next? 9% redeemable bond, Abby. We need two things again. What are they? Cost of debt. And our cost of debt is going to be what? Internal rate of return. All right, please help me with this quickly, everyone. What's the cost of debt for this? Online, please, can you hear me?
Yes.
Hello? Yes, please help me with the IRR for this 9% bond. Redeemable in 2026. Now, you have just 2-3 minutes to do that quickly. Let me be sure we are together. No hiding place. Yes. Yes. Go hiding place. Wait. Or should we all be so best? All right, just because of time, let's quickly. All right. So let's get the details out. We have our coupon, which is the same thing as our interest, Abby. How many percent? 9%. And I told us in last class that that percentage that they attach to that debt is the coupon. 9% redeemable, 10%, that's the coupon or the interest, right? And that's what you use to accrue, the interest annually. And then our tax rates, 30%. So our annual interest, net of tax, should be 9% multiplied by the nominal value, right? Multiplied by 1 minus what? 30%. So that should be 9 naira multiplied by 0.7. How much? 6.3 per annum is our annual interest. Next, we have our tenor. Tenor of this bond is how many years? We already agreed, 3 years. And then market value, very important. What's the market value x interest? 100.84. Is that? So, and we know that the cost here is our internal rate of what? Return. So let's set out the interface. We have year, we have our cash flow, we have our discount factor, and then we have the PV. So our year, usually from year 0, is that not? 1, 2, and what? 3. Year 0 is our what? Market price. How much is the market price? 100.84 outflow. That's how many percent? 9%. And this gives me how much? 100.84 outflow. Then here I will have my interest, and in the last year I will have interest plus what? Redemption value. Okay. So here I would have 6.3. 6.3. Are we redeeming at par or at premium? Okay, so let me state it here. At par simply means 100. Okay. So this is 100 plus what? Okay, let me switch. Plus what? 100. And that should be 106.3. If you have a good calculator, discount factor 9%, year one, figure 0.917, yes. 0.42772. All right, PV. Figure 5.78. Yes, 2 decimal is fine. Three, 7, 82.6. And then our MPV 5.30. This second one 5.30. MPV is it positive or negative? Negative what? Like this. So what do we do? Reduce the discount factor, okay? So let's do discount factor at what? Should we do 5 or 4? 5%. This is still 1. And our PV will still be 100.84 outflow. Help me, 5%. 5 to yes. Yes. PV. Online.
Well, with you, sir.
Precious, are you in class? Ambo.
Yes, sir.
Yes, sir.
Aliyu. Babalola, are you in class?
Yes, sir.
Okay. Zina.
I'm here, sir.
Fantastic. Sophia.
Yes, sir.
Justin Anko. Elizabeth. Ngozi.
Yes, sir. I'm here, sir.
Ifeanyi.
Yes, sir.
Fantastic. All right. Okay, so what's the PV? Year 2. 5.71. Yes. Year 3. 84. MPV. Positive, yeah. 71. Okay, so our no need formula again. Lower rate, Abi. What's the lower rate? 5% plus 2.71 divide 2.71 plus 7.7 multiply 9% minus what? Fantastic. Nasabi book. Figure. AD. Oh yeah, oh yeah, oh yeah, oh yeah, oh yeah. Final figure. For a bond that is not redeemable, what is the cost? Yes. That is not redeemable. It's traded. Market price, Abi. Fantastic. Net of tax, Abi. All right. So the market value of the debt. Remember again, how do you get that? The market price, right? Divided by the nominal. Multiply by what? The book value, no thinking. Market price is staring at me, 100.84. 100.84 divided by 100, multiply. Book value of this debt is how much? Let's go to financial statement. What's the figure? 200. Fantastic. 200. Remember, all market values in million. Help me. How much? 201.68. I think we are done. There are just two sources, right? Done. And then what will be our cost? WACC. Remember, WACC, KE times BE over VO, plus KD times VD over VO into 1 minus T, This is our normal WACC formula. However, remember that the debt that we have here is what? Is that stock, Is it stock now? What's the name of this? Bond, Bond. And remember that the tax effect is already what? Considered. Is that not? So that means there won't be a need for this in that formula. Are we together? All right. So our WACC now, let's get our VO. VO equals to VE plus VD. Is that? And then what is it? What's our VE? Value of equity. 1040, plus VD. 0.68. Giving me VO of how much? 12.68. So that our WACC simply becomes, what's the KE? 14% multiplied by 1040 divide 1241.68 plus cost of debt 6.3% times what? 201.68 divide 1241.68. That one minus T has gone, right? So help me. Final. Now, I decided to use these two approaches so that you choose which one is better for you. You know, the first one we use table, Abi. Look at this one. The first question we solved, we use table format. Where is that again? Yeah, we use table format. You can also decide to use this other method. which is the normal work formula that you know. Same thing, right? So anyone you want to do is fine. But just take note that whichever approach you're adopting, know when the tax effect has been considered and when it has not been considered. So you don't charge tax twice to the cost. All right. Any questions so far? Yes. Yes. Yes, now why not? You can be up to 10. In fact, because in the exam, you may have as much as 5. When you have 5, it's usually question 1. When you have question 1, and you really want to test cost of capital, yes. When it's coming in section B, section C, it will not maximum 3, and they just be simple, just to test your concept, your understanding of the concept rather. All right. Question? Any other online? Of course, table now. Table is easier now. Because you have to now start doing cost of equity, cost of preference shares, cost of redeemable, cost of non-redeemable, cost of bond, it's a lot. So the table will just help you do everything, ash total, and then get your cost. Anyone, any approach. But I usually prefer the table format. And I got used to the table format from, you use Excel. So basically, if you're using Excel, the table format is much more easy for you. So. All right, so let's proceed. What's the next part of this question? Now let's discuss this together. A whole 9 marks, 3 marks each. Let's discuss it together. Without further calculation, so they are saying drop your calculator. Explain the impact of the new bank loan on Felix PLC on the cost of equity. What do you think? What's the impact? Let's discuss. When there's an increase in loan, what is the impact on cost of equity? Let's think about it. What do you think? Yes. To reduce, should remain the same. You know why? We know how to calculate cost of equity, cost of debt, and what. But how this is interplay? How? And this, look at what the mark they gave you here, and look at the mark they gave you here, 9. Now let's look at this together. Every time a company is trying to raise a debt, there are 2 implications. Number 1 is from the debt holder's perspective or the debt investors, and also from the equity side. Now let's look at the first one. The only thing that will affect the debt holders, which is the bank that is giving you loan, is the level of your gearing. When you approach the bank, what the bank will do, they do credit search on you. What are they trying to do? They want to see the level of your exposure and how credit worthy you are. So when they do that credit search and it comes out that you are actually credit worthy and your gearing ratio, they look at your financial and they see that you probably have not even taken any loan. The risk for them is low to give you loan. Why? Because you are not financially exposed. That's one part. But that's not what the question is asking us here. The question is asking us the impact on what? On equity holders. The first thing is the moment you start increasing your gearing ratio, what it tells or the signal it gives the equity holder is that your business is becoming more risky. Why? Because as you're raising more debt, your gearing is increasing. And they are already looking at their exit position, because when anything happens to your company, what happens when they settle who first? Debt holders. So it simply means that because you are taking so much debt now, if anything happens, the balance sheet, the entire asset you have will be sold or liquidated and given to who first? Given to the debt holders first. Increase in financial risk would also increase the cost of equity, because equity holders would demand a compensation or was additional points, bullet points on this. Number 1, is it the PI? Impact of increased debt on equity costs. Equity costs. Number one, increase in debt increases financial risk. Is that true? Financial, is it not? And also increases gearing. Increases gearing ratio. Right? And then increases the overall risk, and equity holders will demand additional compensation for the what? Additional risk. And this will drive up the what? Cost of what? Equity. So we are saying increase in debt also will increase. We are looking at will increase cost of what? Equity. Simple. Please, you understand the analogy? You can decide to expand it your own. This is just me bringing out the salient issues around. All right, let's go on. What's the B? Cost of it. Let's look at what do you think? I think we already mentioned briefly. When your gearing increases, what is going to happen? As the more loan you are taking, the more what? The more exposed you are. Is that what? And then the more also the bank will become ready on what? On giving you more loan. Is that not so? So it means that anytime you're looking at the cost of debt here, it is important to look at the perspective of the company, because when you talk of debt, really, a lot of things come in. Look at this. What's their current ratio? Let's look at their gearing ratio. Currently, they have equity of how much? What's the total equity here? 150. Let's add the reserve, everything. How much is this? 150, Abi. What is the bond? The debt is how much? 200. Is that not? So if I do, let's even say our gearing, we are doing debt to total asset. Right? This total is how much? 350. So that means we are having 200 divided by 350. Multiply by 1 ratio based on total asset. How much? Eh? 57.1? 7.1%, Abby. This is the current ratio. Remember, they want additional debt of how much? Is it 330? 30 million, right? How much would that be?
380.
30 million.
It not be 200.
The old debt is how much?
80.
Based on, we are using book value now. Old debt is how much? 200. 200. New debt? 30. Total is how much? 230. Their new VO is how much? 230 plus how much? Plus 150. Is it not? How much is that? 318? 380, okay. 380. And so if you divide, their new debt is total is how much? 230 divide 380. I mean, how many percent is this?
52.6.
60.5%. Right? So what is happening? Their gearing ratio has moved from where? from 57.1 to how much? To 60. That's the marginal increase of about 3 point something, right? Is it 3 or even 2.8 thereabout, right? So let's write. Increase in debt will increase the current gearing from 57.1% to what? 65% based on what? Book values. Is it not? You can also decide to do your analysis based on market value. All the same. Based on book value. Book value. The debt holder may not necessarily react to the additional debt, additional loan of how much? Of 30 million as the gearing only marginally increases by how much? 3.4% in absolute term. Furthermore, also the equity, or let's say asset, total asset of the company will conveniently cover the debt in case of liquidation. Hence, the cost of debt may be unlikely affected by the new debt. All right, well, you can write it in your own words. What is important is understanding the concept and also how these things flow. Questions? What's the last one on this? Wakabi. On work. So the first keynote is that cost of debt is cheaper than cost of equity. Is that true? Why is that though? Why is cost of debt cheaper? Or equity is cheaper? Which one is cheaper? Is debt cheaper than equity? Why?
Because of the tax implication.
Because of the tax shield, Abby. Yes, because of the tax shield. It's not just tax shield, also the risk, Abby. Most debts are secured, right? So if a debt is secured, it means the risk is actually, if anything happens, go and sell the asset. And like what the banks are doing, now, if you want to take a loan of 50, they'll ask you to go and bring an asset cover that will give about 1.5% of what, that's 150% of what you are taking. So that they know that your asset is going to be sold at a for sale value. So they know they can't get that market price. So they won't equate that loan to the market price of that asset because they know that they lay. All right, so basically, cost of debt is cheaper than cost of equity because of tax shield. Bank Mbede. This guy is not to negotiate business. All right. Because of tax shield and security on debt. All right. So it means that increase in debt will most likely reduce the costs of capital. I agree. Because of substitution effect, but up to a certain limit where work is considered optimal. Any further increase will drive up cost of equity. This is according to traditional theory of capital structure. All right, we'll still come to this. We'll do it in detail, but just for me to understand what I'm saying. Three things now. The first one, equity. When there's cost of debt, what happens to cost of equity? It will go up. And why? Because of the additional risk, and equity holders will demand more. Cost of debt, what happens when you raise more? What happens? It depends on your current gearing and how you're perceived about the loan. That's what will affect how much the bank is going to charge you extra. But when it comes to cost of capital, now it's combining what? The two, cost of equity and what? Cost of debt. We are now saying when you're raising debt, right? The first implication on the cost of capital is that the cost of capital will continue to do what? To reduce. Because debt is cheaper and there's a substitution effect. If cost of debt is increasing, right? Reducing rather, because of the volume of debt. So it means that the capital structure is moving more from equity to where? To debt. That's the substitution effect. It means the work will be forced to do what? To go down. But this will only happen up to what? Up to a certain limit. Because as you're doing that, work is increasing. Because you are not expecting equity to change. Cost of equity to change. Is that not? But you get to a point where equity holders will now say, wait, so why is this company that we are investing in constantly investing in debt? Would that mean that no other equity holder is willing to do business with them? So that means they can't raise money from equity again. So that means this business is actually what? Getting more risky. And the moment it gets to that point, what happens to cost of equity? It will start going up. So according to traditional theory of capital structure, it's saying that every organization has what you call the optimal capital structure level, optimal work. And the optimal work is that point where your work is at the minimum point. So when your work is at minimum point, it means you have, let's say, 30 to 70 equity and debt. At that point is the optimal, optimal point. If you try to raise additional debt, it will increase your what? It will increase your work. And that ends this part of the question. I think we are done. Yes.
What is the impact on work? Because from what you explained, can you take it back?
The impact on work is that at first, what will happen to work? Your work will reduce, right? As you're raising more debt, what happens? Your work will continue to reduce, but up to where? Up to a certain point where equity holders will now perceive how risky that business is. So at that point, if you take more debt, it is possible that your cost of equity will do what? Will start going up. Does that make sense to you?
Yes, sir.
Yeah. All right. What's the next? What's the difference? What's the difference between bonds and bank loan? That is C. C. Bond is traded, Abby. While what? Bank loan is not. Number next. Bond is more liquid, and hence has lower risk compared to what? To bank loan. Number next. Yes. Loan has fixed returns. Is it not? But bond effective returns are moderated by the market price. Market price, or if you like, call it interest. That is, the yield of a bond has an inverse relationship with the market price. Loan may be secured or not, while bonds are not. Bonds may be transferred, while loan may not. It is C. I think they just want how many points or marks is this one? 4, have we? Okay, so just 2, 3, and then explain, and then move on. All right, so that brings us to the end of today's class. In our next class, we are starting. Yes, you want to ask a question? Please go ahead.
You said loan. I don't understand what you wrote there.
Which one?
A fixed return, but bond. Scroll up a bit, please. Loan has a fixed return, but bond, what was that? Is that
loan has a fixed return, but bond effective returns, effective rates. Bonds effective rates are moderated by the market price or the interest. Yes, because it's trading in the market. So the effective rate on your bond is going to be moderated by the price or the market price of that loan in the market. Meanwhile, the normal loan or the bank loan is not moderated by anything. It's just that fixed return that you get, 8%, 8%, 8%. You get that till you are able to pay back the loan. But effective return on bond is moderated by what the price of that bond is. And that comes from a lot of things, economic condition, government policies, and the rest of them. All right. So project-specific cost of capital is the next thing we'll be starting with. Project-specific costs of capital. And we'll be starting that tomorrow for the first 30